New statistics show 1 in 10 off-the-plan apartment sales have fallen through during the past 3 months as the COVID-19 pandemic continues to weigh on the economy. Analysis by Digital Finance Analytics has found that out of around 35,000 sales between March and June, more than 3,000 have collapsed, and that means buyers have lost millions of dollars in deposits. Martin North is the principal at Digital Finance Analytics, and he joins us now. Mr. North, good morning.
Hello there.
So how much money are we talking about when it comes to lost deposits here?
Well, of course, people normally pay around 10% of the transaction up front. So it's 10% of the valuation. Typical property is $700 to $1 million in Sydney and Melbourne. So that's a large amount of money. Plus, there's a risk of additional compensation being required if the developer then has to subsequently try and resell the property into a falling market.
So what are the main reasons that these sales are falling over?
Well, a couple of observations. The first is, of course, a lot of these transactions were commenced in 2017-18 when the markets were very different from today. Since then, property prices have slid in this area, specifically in the high-rise development area, because there's so much supply and little demand with international investors disappearing and with the broader issues, and of course COVID now. Plus, of course, the fact that many are now finding their incomes are different from what they thought because of what's happened more recently. And the banks have changed their underwriting standards, and valuers are pretty conservative because, of course, they expect prices to fall further.
So are there any other charges developers might impose if a potential buyer pulls out?
Yes, so you basically are contracted to complete. If you can't complete, then you forego your deposit. But you also risk the difference between what the developer is then subsequently able to go on and settle the property for with somebody else. So if there's a gap on that, if in other words they settle lower, you might be up for that as well. Plus, of course, legal fees. So the fees can really rack up. So
there's really no leeway here, despite this all occurring in an unprecedented pandemic.
Well, so two things happening. In some cases, the borrower can find another lender, particularly a non-bank lender, who is prepared to offer a bigger loan, but often with a higher interest rate. So you might be able to continue and complete the transaction, but have to pay more. Or indeed, if you're an overseas purchaser and you're not resident in Australia, it's very hard then for the developers to follow up. So what we're seeing there is that some of these borrowers from overseas just disappear, and that leaves then the developer with a bigger problem.
And there's a bit of a side issue here, but still related, this CoreLogic data that's been released that shows more than half of the off-the-plan properties in Sydney had a lower value at settlement compared to the contract price.
Well, that's right. And that's been a trend that's been going on for a long, long time. This is nothing specifically to do with COVID. It's just that COVID's turned up the amplifier a bit on the issue. But this has been going on for a few years, and it's a problem because we've got too much supply of these types of properties into the market. We've got issues, of course, with poor quality construction also now coming to the fore. Property investors are really getting very cold feet in these areas. And so all of those things are basically putting significant pressure on developers. In fact, developers now are even guaranteeing mortgage repayments for a year or discounting deeply or giving a credit back to try and actually get a transaction. This is, I think, desperation stakes.
So is it just in Sydney or in most of our major capitals?
Well, we certainly looked at it in Sydney, Brisbane and Melbourne. They seem to be the hotspots, but I'd also point to the Gold Coast as well, which I think is also exhibiting similar behaviours.
So what kind of impact is this likely to have on developments in the long term? Are we going to see lots of apartments that have been on the market for a long time and remain empty?
Well, there's a huge vacancy problem at the moment in a lot of these areas. So, for example, if you look at 3,000, postcode 3,000 in Melbourne or 2,000 in Sydney, we see some of the highest levels of vacancy rates we've ever seen. More properties are being built in and around that area. And of course, there's now government incentive schemes to try and encourage yet more building. Frankly, we've got a supply-demand disequilibrium, which means prices will only go one way down. It's very unlikely that we're going to see huge demand from international investors anytime soon. The property investor sector, I think, more generally in Australia is looking very weak with rentals dropping. And, of course, the supply of rental property is rising too. So this looks to me to be probably the tip of the iceberg in terms of actually the property market resetting lower. Houses different, but the high-rise apartment sector looks to me very, very, very sick indeed.
And there's also that other grim news for the property sector this morning, Martin North, with Lendlease now expected to book a loss, I think, of between $230 and $340 million this financial year. What's going on there?
Well, of course, a lot of the big builders are very much leveraged into the construction sector, particularly the apartment high-rise areas. And, some of these are very well-known names, and they've got very large, big developments running. But, of course, if they don't have people to buy them at the end of the day, they've got to sit on the properties potentially vacant. They might be able to let them short-term, but, of course, short-term lets are hard to do at the moment. So they're sitting on this legacy of investments that they made over the last 2 or 3 years. And the difficulty is that unless you think that things are going to recover quite quickly, these losses are likely to continue. The number of new starts will continue to fall. We saw the building approvals were down recently as well. So it looks to me as though this is going to be something which is going to hit the sector not just over, the next 3 to 6 months, but probably 2 to 3 years.
A pretty grim outlook overall, Martin North. Look, thank you for your time this morning.
Good to talk to you.
Martin North there, the principal at Digital Finance Analytics.